Good morning, Brie. How are you?
I'm well. How are you doing?
Very well, very well. So it's really great to be with you and to start exploring or looking at some of the insights that you'll be sharing with a whole range of advisors while you're here in Australia. You've got some amazing research that you've been putting out which really looks at how advisors should be thinking, engaging with their clients, really around segmenting their clients. Mm-hmm. Can you just give some insight into why it's really important that advisors do think about segmentation when it comes to their client interactions?
Sure. It's a good place to start. Yep. When you think about operational scale and efficiency, segmentation is a part of that. However, for you to raise the bar on the client experience and also deliver a wealth management experience, whether it's in the advanced planning space with the services there, or the connection to investment management, or how much experience they've had in the financial realm, we have to move into a more modern segmentation strategy. So most advisors do segment, tends to be on the traditional demographics, assets under management, perhaps age, important. But we're missing the overlay of who that investor is, because not everyone's cut from the same cloth. And those insights can help you be more precise in giving them the experience that will delight. So the psychographics matter. Things about how they like to engage, frequency, their experience in the financial realm, the amount of services that they're utilizing, opportunities that are in the near and long-term horizon. Those start to shape more of these archetypes, which allow you to be more profitable, but again, delight in the experience. So this modern segmentation of the psychographics plus the traditional demographics will help you stay on your front foot as the advisor and even uncover some opportunities to align service with excellence and create that loyalty that is second to none.
Well, Brie, I think even in the research that Australian Retirement Trust has been doing over recent years with advised clients, something we've found is that the visceral is actually really important to clients. I think traditionally we've maybe thought about the advisor experience as being about knowledge, about product, about selection, and really thinking about segmentation, probably, as you said, more traditionally in meeting those. Would you agree that you're saying that it is more about the visceral, the emotional, the relationship that you have and how different segmentations respond to that?
I would. So if you think about the competitive landscape and how do you differentiate, it is through the experience. No different if you think of your own self as a consumer, which we all are. And when you think about the brands and the services that you gravitate towards, it's typically due to the quality of the service and the reliability, you know what you're getting, and it's consistent, and you have happiness around it. It doesn't mean there's not pain points. It's not all sunshine and flowers, but you tend to align with those that are sort of the emotional quotient, not just the logic.
And even when you talk about those pain points, it's also a bit about how you respond to those and how you handle those. So we'll try and unpack some of this a bit more deeply, but can I ask, probably as a starting point, what are those high growth segments that you've really identified and for advisors to think about in their own segmentation?
Sure. So for growth, it's important to identify the type of clients that you want to serve. We don't want to be everything to everyone because that isn't going to be a profitable approach. And from a scale and efficiency standpoint, going to probably pull the resources down, the team down. So we did some research on where, when you think about growth for the next decade in particular and even beyond, which client segments have high potential, meaning they're interested in advice, they have financial needs at this stage of their life and also in the roadmap ahead. And they are going to also be a profitable consideration. We don't want to think of necessarily clients as, widgets with equal dollar signs, but when you're applying resources, both the human capital element and the resources that you are investing in, like technology, you need to be aligned with the client you want to serve and how your model is being built. So the four that we explored was the hybrid investor,
Yep.
That is someone that has a dual nature. They have a self-directed account that's not retirement specific, so a self-directed brokerage account, and they also engage traditional services with the human financial advisory team. They want the best of both worlds, but they're a profitable client, and in Australia, based off of the equivalent, it's probably an average of 1.8 million investable assets, which is a very attractive client. And as they progress on their financial journey, it's about closing the gaps that a self-service platform alone cannot do well, or is overly complicated for the individual to really be successful at. Tax strategies would be an excellent example. Women investors, we've been talking about them for a long time, but they're 51% of the population. They're really coming into their own due to the she economy, so their income earning power, not just the inheritance element, which most women will actually inherit twice in their lifetime, so intragenerationally, so spouse to spouse, and intergenerationally, parent to child. So that's also income when we think about the next decade, $14 trillion that women will be inheriting on top of their own income earning potential. Their dimension in terms of their journey is very complicated because they tend to step in and out of the workforce for caregiving responsibilities, child and or parents. That it impacts the amount that you can put towards investing. So having a plan that aligns with the ebb and flows of that different dimension, which is unique often to their male counterparts, really is about aligning the service model with that.
And it's certainly something, if you think about the Australian condition, that our superannuation system, which is really predicated on consistency in the workforce over a long time,
it's very
certainly
important,
has an impact. Can I ask, both in terms of what you're saying with that female population and the opportunity there, the growth opportunity, but also in thinking about that hybrid consideration, do you also think, I know that we're not looking at segmentation here in the traditional model of age and things like that, but is it also how people change over time, that you see that the model or the way they want to engage is also something we have to think about as being dynamic?
Yes, so very rarely does the plan and the goals that you set when you're 25 still exist outside of the core, retirement, maybe education, and family planning. Those are usually on everyone's plan. But how you get there and the variable elements of income contribution, life's curveballs, the factors that are external around market and economics, all of that changes the journey and the way one likes to engage. So it would be a mistake for us as an industry or even an advisory service model to assume that it's going to be the exact same plan and client experience through and through. So the ability for us to have a model that evolves with the client is important. There are core foundational elements, so obviously you have scale, efficiency, and effectiveness in how you meet clients where they are, but you have to show them that there's accessibility, fluidity, and on their terms, which will change because they may be exceptionally busy and don't have enough time to see or talk to you as frequently as they'd like to. So how do you help close that gap so they don't lose sight of things they need to be doing to make forward progress, staying engaged with where they are on the plan so they have confidence in their financial security? All of that is important.
You talk about being there where they are or engaging them in that way. A lot of what you've been looking at is in regard to engagement with millennials. And even if we think about the growth opportunity there, we've got this huge population shift. When it comes to millennials, how are they different with the advice relationship or what they're asking for or needing? What is it that you're saying?
Sure. So not to paint anyone with a broad brush, but there are some commonalities that can help us center on what's different. So easier to compare maybe the boomer generation with the millennials. So millennials today, they're running into their 30s and 40s. And it's a huge segment of the population. In Australia, it's just under 30%. In the US, they overtook the size of the boomer market in 2019. They're a force to be reckoned with. They also grew up with technology, so all things that technology enables for transparency, accessibility, ease of communication and engagement across any sector does not exclude financial services. So some of our models have not kept pace with that experience. So it's the experience economy when you think about a millennial investor, that they expect the wealth management and the advisory relationship to be seamlessly effective at doing. And what worked for a boomer segment in terms of maybe more frequency in face-to-face, more traditional explanations around some of the asset class considerations for diversification. Those translate, of course, to investors across the whole spectrum. But when you think about millennials and what might get them to the table, often it's alternatives or new innovations in investment, digital currency being another good example. So really actively listening and not assuming is the best place to start on what are you looking for, how frequently would you like to engage, in what mediums, and how can we design an engagement strategy that's going to complement where you are not only in the financial journey, but also in your own style.
So in thinking about that style, and it's something we're very conscious of, again, in thinking around the way we're educating all our different members, in thinking about, if I look at millennials for a moment, it's that they're seeking out information in a whole new way.
Absolutely.
They're wanting to explore things themselves. They also maybe have a bit of wariness of institutions that older generations didn't.
Yes.
How do you see that we tackle that? That when it comes to an advisor who's trying to engage with millennials in different ways, how do they even start that process, do you think?
I would approach it through a collaborative relationship. So, and again, not to paint everyone with a broad brush, but usually based off of this desire to gather information from multiple sources, it's level setting on let's make sure our sources are trustworthy. If you follow certain influencers on social media, as an example, what you might hear within your workplace, within your family, and then the trusted advisory team you're working with. Because information is power, and knowledge creates opportunities. So having an engaged client's a great thing. How do you complement what they want to learn about, how they want to learn about that? So you become this objective sounding board that brings it more to this healthy framework for how we reach decisions. That's key.
And does that also, though, bring some risk that millennials, for example, might be coming with presumptions around how things work? Or so is there a whole different way we're having to think about what we're talking to them about or what we're having to tackle than maybe we would have had to do with their parents?
So a good way to think about that is, even if it's a discretionary type of relationship where every decision that gets made in the investment element of the plan, you don't have to check in and say, do you want to do this? And you're updating them after the fact, or you're proactively preparing for, like, this is what we're going to be thinking about this year. It is through the active listening, really understanding where are these questions sourced from? Is it based on pure interest? Is it behavioral in terms of fear of missing out, FOMO? Is it due to what the talking head on the news had to say? So there's context behind what the inquiry is on or the information they're sharing with you, and then connecting that to their plan, their goals and aspirations, because it may or may not be relevant. But they may also be asking just to satisfy from a curiosity standpoint to further their own knowledge as to, well, when the markets, were so volatile, how is that impacting when I think about 2025 and performance? How is that also going to change my liquidity needs in terms of that bucket of the finances? I think when you can meet them where they are in terms of satisfying the information, but helping them relate it to, this is what's working for you, and let the rest just be with the white noise and move on, that's really what is the context of the value of having that financial advisor.
And you and I were actually talking prior to when we started filming, we were talking about how internationally there's probably a couple of locations that have been outliers in some of your research. But when it comes to again, thinking about millennials, but even more broadly, do you see that there tends to be, whether we're talking about the American experience or here in Australia, is there consistency across there, or are there areas that you have seen start to emerge that are quite different or interesting?
So there's a lot of commonalities between the US and the Australian investor. Not everything is an exact match, of course, but the differences aren't statistically significant across the board when we think about communication style, expectations in the client engagement model, interest in investments. There are different levels of awareness and education and empowerment when it comes to someone taking their seat at the money table. A lot of that has to do more with cultural and societal norms. Both of those are significant factors. And then when you add traditional demographics plus the economic environment, those four factors really shape individuals or generations. And that's where you start to see some differences. So if there are cultural or social norms that are unique region to region, like in the Middle East or in Japan, that can have a significant impact on how much or how little financial experience a particular gender may have had, or a millennial versus a boomer. I think one trend that we've seen across the board, just due to technology, which creates connection and access to information 24/7, is people have more at their fingertips, so there's a lot they can help themselves with, but the context behind how that relates to who they are, what they're trying to do, and if they have a financial plan and an investment portfolio connected to that, that's where you start to see some fractures in uniqueness. And we want to create an environment as an industry where, regardless of experience level, and that there's always a solution, even if you're just getting started with low investable assets, let's get you saving early, investing early, so you can take advantage of core things like compounding and achieve your goals maybe sooner than you could before.
Do you see that perhaps that's where circumstance in Australia with having a universal retirement system and giving everyone the opportunity who's working to really be starting that savings strategy so young, we've probably seen that system maturing, or we've definitely seen that system maturing over the last few decades. Is that where we really have an opportunity here? That we've now got a system in Australia that is very mature, that everyone's quite aware of. It really also has that growth opportunity for millennials. Is that something you see as unique for the Australian condition?
I do. So if I think about our US market and retirement, our boomers were more into defined benefit and defined contribution opportunities, and the government helped shoulder some of that burden when it came to your retirement savings and your income strategy. As that policy shifted and generations changed, Gen X, there's a little more split on that. And as I think about millennials, it is more of the workplace savings, and the burden really is on them to get started and take advantage of it. And if you're participating in the gig economy and there's no corporate plan supporting you, you have to utilize other vehicles that are retirement effective, like IRAs. So what you're talking about is you want to have a captive audience from the very beginning. And I think it's about closing the gap of this is your money. And if you start putting it to work as early as you have the opportunity to do so, then when you actually need it and can utilize it for your retirement phase, you're going to have so many more advantages than you would have not had before if you didn't really turn that on.
And is that maybe where we've done it wrong to some extent to date, that we talk about it from a retirement sense as opposed to really thinking about it's your money now?
We've been in this market a few times now, which is always a pleasure, and learning on the ground makes a big difference than reading about it or talking through phones and virtual connectivity. But I still continue to hear this. I don't feel that it's my money, that ownership, and I think that is gap one. Two, retirement's a friendly topic. So our research shows whether you are a boomer or a millennial, retirement's one of the top 3 priorities as a goal, but it's also one of the top 3 concerns. So even though for a millennial who's running into their 40s and they have a longer time horizon before retirement's even here, and they're still really shaping what that retirement vision looks like and the strategies they'll actually need to bring it to life, it's front and center for them. So I think you bring those two worlds together. So really their possibilities could be perceived as endless by starting early. So it's opportunity, advantage, this is ownership, be engaged. Your money should work as hard as you do. And I think that's a positive message, whether you apply that towards the retirement phase or that becomes the mindset of how they own their wealth.
Let me go back to, you talked about the importance of the trusted relationship or the importance of trust, and certainly the research we've done at Australian Retirement Trust has very much been focusing on where does trust sit within the advice experience. And what our research uncovered, quite striking in fact, was, as I mentioned earlier, that it's not product knowledge, it's not what you're being told around investments, it's not performance. Ultimately, a person's relationship with their advisor becomes strong on them feeling that the advisor's in their corner or has their back. Even when we asked advised members around how they describe the advice experience, almost every word they used as a descriptor was something quite emotional. It was all about how they perceived that relationship with the advisor, not necessarily what the advisor was doing. Is that something you've seen yourself, and why, and if it is that why there really needs to be also this focus on connecting with the client on their terms to build that trust? Is that the basis of what we're talking about here?
Yes, so investing is ultimately a human endeavor. And you cannot separate the emotional element of decision making. So all the logic in the world will not motivate someone to do something or create a change, take action. It's about awareness of that emotion. So from the relationship standpoint with the advisor and the client, it's consistency. It's the fiduciary standard. It's the transparency, which all those factors contribute to trust. It takes a while to earn trust, takes a second to lose it.
It's a point I was going to make. Do you see those points of loss quite clearly, where you've talked a lot about those areas to build that trust, but do you see those triggers that often just break it in an instant?
Yes. So responsiveness to whether it's a service request or a question, that's a breakdown for sure. Where someone will, you know what, I'm just going to pick up and go somewhere else because I'm not getting the care and the attention that I think I deserve. Everyone wants to be respected. And the service and response level, I think, is important. And when you think about millennials, they're used to instant gratification or fast service. We have to put that within context of, what type of time do certain requests take, so there's a level setting of that, so there's not a disconnect there. But being, if you make a request, send an email, send a text, or whatever the mode of communication is, they're going to hear from you. So it's acknowledged, heard you, this is what we're going to do. So they know it's in progress. That goes a long way. Where the other disconnect happens is with performance. So if the context around what's happening in markets and you open up the statement and everything's not what your expectation should be, you have to remember that's a measurement against an arbitrary benchmark. There is no, in that statement, measurement of what is that portfolio supposed to be doing, its purpose, and are you still on track based on what's happening in the markets when you looked at that statement? When that communication breaks down, then someone will leave if performance doesn't meet their standards because they don't have the personal benchmark focus there, and that's, again, central to the relationship.
Where do you see education fitting in to that? It's a core part of communication. It's maybe a core part of setting those expectations. The advisor's role in education of their clients, do you see that as critical to both of those, or are there other things that you think an advisor should be thinking about when it comes to the education of their clients?
So I think education hits the three elements of the value proposition. So the three elements I think about is there's the behavioral management, coaching clients to become more self-aware of where their emotions come into play. It's not about removing emotion, you can't take it out, or bias, we all have it, but it's mitigating some of the self-sabotage behaviors in a way that doesn't make someone feel less than smart, but it's knowledge is power through self-awareness, and coaching them to better outcomes. And that's consistent across the client experience. In the investment management, we talked about the personal benchmark connection with true returns, and the alignment then with the third, which is the wealth management. So the financial plan being the foundation, but also all of the services, whether it's estate planning, tax efficiency, family planning, and so on. All three of those work together, and there's education in all three elements. And if you have clients that want to embrace the mindset of knowledge is power, let me learn as we go, this is a journey, and it's going to take, it's like the marathon, not the sprint. You can meet them where they are, and whether that's through traditional forms like a webinar on alternatives, or if it's education experientially as you're talking about financial security, and let's take a step back and look at where you are versus what we're trying to achieve within your longevity bucket. Those are educational moments too.
Your reference to the marathon I find painful for both of us. We were sharing that we've both got running injuries at the moment. The last thing I want to cover off on, I know there has been a lot we've talked about, but you mentioned throughout around, particularly when it comes to women and this intergenerational wealth transference. Intergenerational wealth transfer is a very big thing we've got ahead of us, and it's going to require multi-generational discussions. Our own research again has found that trust is an enormous part of bridging those generational gaps. But over the next decade, as advisors are thinking about whether it's inheritance movement from a spouse or parents, or trying to engage much younger people with advice because of almost this instant wealth that they're seeing. How do advisors start to tackle that, and how do they try and bridge that trust across generations, or even thinking, you've just mentioned education being different across generations. How do we start to try and handle all those different?
It's a lot of moving parts.
Yeah.
So I would think about it through two groups. You have your wealth creators, the ones that will be passing down the assets. And then you have your inheritors, ones that will be receiving these assets. And we also keep in mind, not every asset is going to go within the family. There's charitable giving components. If someone is philanthropically minded, that may be an element of their estate plan. So it starts with purpose. Once you understand from the wealth creator standpoint, what would you like to think about when it comes to legacy? And which is a very big question. You have to do your traditional discovery to help them map that out. Then part two of that is, let's communicate this plan. You don't have to do dollar signs when you're talking intergenerationally about the estate plan, but roles and responsibilities. If values, and I'm not talking about sustainable investing, I'm talking about values around what money means, how we earn it in this family, how we apply it, how we grow it, then the goal there, if that is their purpose, is you don't have the proverb shirt sleeves to shirt sleeves come true, where the first generation created the wealth, second one receives it, spends it down, contributes a little bit to the growth, but by the third, it's kind of wiped out when they receive what's remaining. And that's usually not in the vision of one's purpose when you think about legacy. On the inheritors element, the values of what the dollar is worth, how to be a responsible steward of the assets, starts with those small money lessons, and even well before assets transition. So when you think about children that are going off to university, the basics of budgeting, cash flow management, how they even funded advanced education, those are all natural learning moments that, just due to simply culturally how comfortable you're talking about money at the dining room table, the advisory relationship can help break some of those barriers down, and that's how you start creating those connection points and familiarity. And then structurally, as an advisory team, team's important because eventually the lead advisor, he or she will retire. And if you're thinking about asset continuity within the family, who, from a transition management standpoint, will those younger members be working with? So don't take that as an ageism statement or even a gender or diversity statement. It's about, this is a commitment to a relationship that you would like to last your financial journey, ideally, as the consumer. So if you can show them the continuity of care as your team evolves, as their life evolves, you have a winning proposition there.
Brie, truly, we could go down rabbit holes with so many of those, but if I could ask you just to, a lot to try and compress there, but if there was a closing charge or challenge or opportunity you would call out, what would that be? If there was something that you wanted people to straight away walk away and run with, what would that be?
So I think it comes down to having a plan for your engagement model. So first and foremost, that starts with who do you want to serve? Sharpen that. Is that the hybrid investor? Is that women? Is it Gen X? Is it millennials? Or a combination of some of those groups. Then sharpen your segmentation strategy so you can look at your service model and tighten that up. So it's operationally sound, but also has profitability guardrails as you continue to grow. And the third is your team strategy, your human capital, because your aspirations have to meet how you're executing it with your people power. And when they're disconnected, your aspirations may be spot on, segmentation strategies, sharp as it can be, but if you can't deliver the human capital and the resources that you need to bring it to life, then it's not going to take off.
Thank you very much for your time.
My pleasure.
Look forward to spending the next few days talking to advisors with you. Thanks,
Great.
Brie.
Thank you.